All right, folks, welcome back to the Property Couch podcast, and have we got a great show for you today. The first thing is Q&A day. It's our favorite time of the month, and have we got some great questions for you today. First of all, we're going to cover what happens if a real estate agent sells their own home and a sad story that's attached to that. And second thing is, how much tax knowledge should real estate agents have, Ben?
And in addition to that, Bryce, we're going to tackle that old age cash flow liquidity story with rising interest rates. And finally, we're going to be talking about getting back on the horse after a divorce.
Oh, Ben, I like
Heaps
what you
to
did there. Plenty on the show, folks. Let's rip into it now.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. And of course, welcome back to you, mate. How are you?
Well, winners are grinners, Bryce. Winners are grinners. We almost stole the defeat from victory, didn't we?
Yeah.
Like we were cruising with 2 minutes to go and they kicked 3 goals. And whoo, anyway, we've beaten the undefeated, so that's good. And you guys had a win.
Yeah, no, I'm not talking about footy. So I've declared that a couple of weeks ago. So I'm not talking about free.
Is that the strategy? Hoping that not talking about it, they'll win more games and then you'll come back for it?
Nah, I've said this to you on off air. I've probably said it to you a couple. It just feels like the same old every week, and I'm just not getting any joy out of it. So I'm just taking a spell. That's it. So if they perform all right during that time, great. But it just feels like it's the same old. Hey, good idea for tourism in Adelaide, though. I think for those people who are listening, who are in South Australia, who enjoyed what would have been a carnival-like atmosphere. I am keeping a sneaky eye on the roster for one of the next 3 years, Ben, to go over there and enjoy some of that myself. I think that'll be fun.
Yeah, no.
For the South Australian economy and the geography and just to feel like that part of that carnival, I think would be fun.
Yeah, no, a few of us were talking about going next year. So that just gives you some idea that it's certainly got a little bit of curiosity about it. Going and having a look at a game maybe in Mount Barker or something like that makes good sense to us in terms of being able to coordinate that. And they'll just maybe need to do some work over there and call it a business trip. Just kidding. Just kidding.
Mate, special shout out to those people who do work at the tax department, listen to our podcast. We appreciate you tuning in. Hey, you just for the NRL people who are listening to our podcast, Ben, it's fair to say I'm not very clued into NRL. I've lived in Queensland. Spent a bit of time following the game, but to say I'm a purist, that is not true. But I am speaking to a very high-profile NRL person. Spoke to them yesterday, and they want to come on to the show and share a lot of really cool insights about themselves, being a professional athlete, and a very big property investor as well.
Sounds interesting
for that. NRL fans, this person will be no stranger to you whatsoever, and I've enjoyed the conversation to date, and we look forward to getting him on the couch shortly. Ben, I'm not going to drop names yet, but stay tuned. That is coming very, very, very soon, just so that we provide a little bit of balance here, Ben, on the NRL versus AFL stakes. Hey, you've had some updates at Moorr that you want to share with the community.
Yeah, we put a couple of releases out over the weekend, couple of, just tidy up hygiene things, but really important. 2-factor authentication on the web version of the platform. You can now do email as well as Google Authenticator. So for those people who've had challenges with Google Authenticator, that hopefully will give you a plan B if you want to authenticate through an email. And also, Bryce, we've updated some of the expense item naming conventions. So we've had some naming conventions in the past there, such as, car registration.
VHS videos.
Yeah, DVD hire and all these types of things. So they've been updated a bit. TV subscriptions and now digital subscriptions. So there's been a little bit of hygiene there. But for those who also lived in owner-occupied properties who have owners corporations or body corporates, as they're called. We didn't actually have a provision for that, so now we do. So we've got some new categories in there as well. So if you haven't checked it out, remember it's the home of Money Smarts. It's the home of Wealth Speed and Wealth Clock. So if you haven't checked it out, check it out.
Very good. Yes, definitely check that out. I just want to do a shout out to anyone who loves socials, Ben. Our team has really refreshed our socials and it's looking fabulous, and we're getting lots of high quality content put on there. So if you are a fan of listening to our podcast each and every week and you want some little snippets and you're a fan of social media, despite my life hack of a couple of weeks ago, Ben, where I said I'm off social media and only on my tablet, but there are people who just love being on it, and that's fine. If that's you, go and check it out. We'll put some links in the show description so that you can go and check out all of our socials. Well worth a look. Looks great. Lots of great content. Little snippets to. They might take a sound grab of something that you and I have said on an episode that we think is timely and relevant and can help people reinforce the point. So we are active in Insta. We are active in Facebook. We are active in YouTube. We are active in LinkedIn. There's a whole, whatever you love. We're not TikToking. Sorry, folks. For the TikTokers.
We're so active, we don't even know where we are.
We're not TikToking. And here's the deal, right? You can actually, if you go to our Facebook, Ben, you can actually see our wonderful team now is actually, not only is this an audio production, it's a video production. So for the last month, we've been doing it as a full video production that you can see on YouTube, and you can also see on Facebook as well. So if you want,
and now I've got to concentrate, Bryce, and I've got to open my eyes more. I've had some feedback to say that sometimes I just keep my eyes closed for the session of what I'm talking about. I just did it.
Cheeky cheap shot at Ben from the bleachers before we push record here, because
no, it's all good. I've got to get better.
When you see him do his the hook at the beginning of the show, it's like he's about to belt out a classic ballad because he's got his eyes closed and he is just recalling from the far recesses.
I need to put their hand over the ear and pretend that I'm there.
Exactly. So if you want to go and check out that for a laugh, for a bit of insights, you can see that. But I've prompted you, so you probably won't have done it on this episode.
Oh no, I'll try and do it again. I'll see how I go.
We'll check it out. So there's a couple of things, folks. Updates to Moorr. Socials, go and check it out. We would love to. We're putting a lot of effort into providing you with more free value in those landscapes. So go and check it out. We're pretty close to 20,000 on Insta. So if you could help us, share with your friends and get us over the line on that, we'd be forever appreciative. And of course, Ben, if you are wanting to give us a review, click the button, let us know. We read them. We love the feedback. It keeps us fueled. And every now and then someone gives us some really constructive feedback that we take on board. Let us know. Hey, my Mindset Minute theme today is on the 16th of June 1993, Warren Buffett, along with 8 other CEOs, was invited to the White House for lunch with the US President. Ben, quick quiz. Are you reading? Do you know who the president was back then?
No, I don't.
Bill Clinton. Hey, helped you out.
Billy.
Well, you didn't close your eyes as you were recalling them, so that's good. So
no, I looked up to the corner then, didn't I?
Up to the corner and to the right, yeah.
I was thinking about whether the fact that we hadn't told anyone it's a Q&A day show today, so that's probably where my headspace was. But it's a Q&A day, so hang around for Q&A.
Yeah, nice one. Hey, love what you're doing. So following, back to my story, Ben. Back to my story.
Sorry, mate. Sorry.
Yeah. Following the 2-hour presidential lunch, Warren Buffett was interviewed by reporters, and a reporter asked him whether the stock market was currently undervalued, and here's his response. I've never been a good judge of the markets. I try to evaluate specific businesses, and if I could evaluate a few specific businesses every year halfway correctly, I'd look at it as a successful year. I've never made any money guessing which way the market's going, right? So interesting, right? So then I thought, I'll have a little play with this. So what happens if I just substitute 2 words in that whole statement, Ben? And so if I tweaked it as follows. Let's say I could edit what Warren said, and it said this. I've never been a good judge of the markets. I try to evaluate specific properties. If I could evaluate a few specific properties every year halfway correctly, I'd look at it as a successful year. I've never made any money guessing which way the markets are going. So here's the greatest investor of our time, Ben, who is saying, I don't actually worry too much about what's going on at a macro level. What I do is I just analyze businesses, and I look under the bonnet of a business, and I work out if that business has got something that would suggest it's undervalued, and then I set a price. And if that price actually drops below that price, I'll probably buy it. And if it is above that price, I probably won't buy it. So it's not saying, do I think the market's going up? Do I think the market's going down? It's actually saying I am at a granular level looking at the very thing that I'm investing in. And so I've been cheeky here, other than to say that, imagine if you overlaid that in the property market and just went, I'm not buying what the market is saying I'm doing. I'm actually not buying a suburb. I'm not buying a street. I'm buying a property. So if I could evaluate a specific property and make a judgment based on my own circumstances whether I should buy it, and then if I could actually make some judgment calls on a handful of properties throughout the year, so that then I can decide which one I want to buy. Because the reality is, for property investors, not a lot of people are buying 2 and 3 in a year. They might be buying one every year or one every second year. But I just want the logic to land that this person was not getting caught up in market cycle timing at all. They were focusing on the asset, not the category. And it was all about buying quality assets. And listen to this, folks, I'm just holding on to them.
Hey, Bryce, this is gold, right? Here's the reason why it's gold. I didn't know what was coming on the Mindset Minute because I hadn't refreshed my screen, right? So here's an article that I read
400 episodes.
from. Here's an article that was in the Fin Review, and I think it's quoting Warren Buffett. So this is last week. So almost 30 years later, and he says in that interview, never really worried about the macro. Never really worried about the macro situations, right?
Yeah.
Never been a good judge of the markets. Never worried about the macro.
Yeah.
Just if I could evaluate specific businesses, aka properties, and do that over the long term. Now, 30 years later, he's still consistent in his messaging. That's what makes him the best of the best, because ultimately he's found a formula, it's worked, and he's stuck with it over that journey. And I think that speaks volumes in terms of the message there in that Mindset Minute. One of my favourites, Bryce. It's gone straight to top 10. So well done.
Straight to top 10. Thank you, mate. I'm researching at the moment because I think I've been doing this long enough now to know, Ben, that my biggest disappointment comes along when I speak to someone who, you've got this small group of people who actually will invest, right? And then of those who do, the ones that break my heart the most are the ones that get derailed by their heads. And so I'm more like, whenever I'm trying to get a guest on, I'm just researching a book at the moment that I'm speaking to the author, and he is going to come on, and it's a book about the share market, Ben. And you think, okay, you guys are the property couch, but it is just a book about mindset. It's just a book about how you actually play the game that we are trying to teach our community to play, which is focus on the micro at your own balance sheet and cash flow level, and then zoom out for as long as you can so that you can actually play a decades game. The more and more I'm doing this, the more and more I'm fascinated, the more and more I want to get in the minds of those people, the more and more I want to get those people onto our podcast to share, so that by sheer repetition, hopefully our community gets that it starts with a bit of action. Once you've had a bit of action, realize that along the journey, you're going to be faced with a bit of volatility. You're actually going to be faced with some external stuff that's going to make you feel wobbly. And those people who can withstand a little bit of breeze on their face and actually stay in the game long enough, they're the ones that actually reap the benefits. So as I'm researching that, I'm reading that book, this quote's coming up. I think, this is a beautiful thing for what we're talking about now. And hopefully anyone who's been listening for a long time, Ben, I just reinforced the same points. I just look for a different way to say the same thing about playing the game better.
There's one superpower, Bryce. There's only one ultimate superpower in investing. And you mentioned it in that list, and it's just action.
Yeah. Taking
action. It's the only superpower, because ultimately, it comes back to what Jordan said. You miss, 100% of the shots you don't take. Right. So the reality is, part of why we talk about mindset, part of why we try and build confidence and understanding about knowledge is ultimately to take action. If you do not take action, you will not have the experience. You will not live. You will not be able to improve your situation and so forth. There was a recent report that came out around the wealth, the wealth disparity between the haves and the have-nots.
Yeah.
Right. And it was quite a manipulative paper, because what it basically showed in terms of the variation between the haves and the have-nots is because it just used income in terms of the measure of wealth. And obviously the people who have all the haves, guess what? They don't earn all their money from exertion, from working. They actually earn from the power of compound, from the power of time, right?
Wow.
And that's what is happening. That is what's happening around the world for those people who have been investing for 20, 30, 40, 50 years. They have the benefit of time and the benefit of compound. And so it's misrepresenting the story here, but it's trying to argue for a story that, there's greater inequality in Australia than ever before. Well, that will still be the case, because the reality is, if I'm getting a compounding return on $1 million a year and I'm getting the same return on $100 a year, you will not be able to catch me. You will not be able to get to that situation. So what does that tell all of those people who are thinking the government's got to save me, the government's got to do the heavy lifting for me? It doesn't tell you that at all. What it tells you is get busy investing, get busy acting on investing, because you'll be forever blaming someone else for your ultimate outcome when we're talking about building habits and taking action. So there you go.
Ooh, nice. Taking action, be ready to face a bit of breeze or a bit of headwinds once you've taken action, and then just stay in long enough in the game.
Well, plan well, and you'll be expecting those breeze. Like Buffett, I'm just don't care what's happening in the macro. I'm just interested in these really good businesses, and these really good businesses will do well because they've created competitive moats and they're really good at what they do. So, he doesn't buy the market, he buys businesses. We don't buy the Australian property market. We buy houses or units or villas or townhouses. So just get with the program.
Get with the Ben, I was just thinking, as you're saying that, the property that's in my portfolio that I've held the longest was back in 2002. I bought it for $191,500. It's now over, over 700. But the at the time, it just seemed like an extraordinary amount of money, so the only way that you get to make those observations is if you take action. If you otherwise you can't actually feel that feeling within you when you look back and you just go, it's not the same when you talk about the fish that got away. It's actually you only get to internalize that. Anyway, labor on that, folks. So
very good.
Have a think about that. Yeah, the great Warren Buffett, what he said about market cycle timing. Hey, I don't know if we mentioned this at the top, Ben, but it's Q&A day.
Q&A day. Who would have thought? Q&A, beautiful. Love it.
We love Q&A day.
Maybe we need to put it in the title so people know it's Q&A day.
We'll find a good title for this one. But the first one is, so the first two questions, I'm going to read them out. And then the second two questions, we're going to have our guests read them out because they're on speak pipe. So the first one is about real estate agent disclosure, Ben, which is going to be a good little topic for us to riff here because there's so much in this question. But it's this is from Jane. She left a comment on Facebook for us, and here's how it goes. Hi, guys. Love the podcast, and I'm hoping to answer a question for the pod. I recently bought a property in Melbourne off-market. Key facts. I used a buyer's agent, another key fact, thinking that it was a smart move and ultimately purchased an off-market property. I've just realised that the real estate agent we were dealing with was representing the vendor. Was actually the vendor owner. So, folks, the real estate agent was the owner of the property. He did not disclose this to me or my buyer's agent and took steps to hide that fact. For example, he spoke about the vendors and what they had told him about the property, going to ask them questions, etc. I already had concerns with this real estate agent as he initially told us the property was well within my budget. However, after the first inspection, this changed to my maximum budget. Imagine that, Ben. He also told us the kitchen and bathroom were recently renovated, which was not true. There are a number of other things he was dishonest about, and I've also just realised that the sale price for my property is half of what I paid when I searched online. My buyer's agent has essentially said they didn't know either, and that's that. I have a number of concerns with this property, which I raised with my agent and put a lot of trust into her. To add, 2 other apartments in the building were for sale. One sold $123,000 less than mine, and the other is for sale for $140,000 less than I paid, in brackets, identical layout. Can you provide guidance on where someone in this situation can go regarding all of this? And this is the bit that broke my heart, Ben. It took me 10 years to save this house deposit. Gah. Thanks, guys. Jane. All right. Wow. There's a bit there.
There's a lot wrong with this story, Bryce. There's a hell of a lot wrong with this story. Obviously, the first part for me is it screams, obviously, misconduct. There's no doubt, right, in terms of what it screams. The other thing is, how did the property get to her maximum budget, to Jane's maximum budget? If I'm using a buyer's agent, how's the buyer's agent not knowing? Like, I see there's so much wrong with this story. Like, if I'm buying in an apartment block, your buyer's agent should be giving you comps of what sold recently in that particular apartment block. Number one. Now, even if they haven't sold recently, I would still like to know of a couple recent sales for like and identical layout properties. So this just stinks, Bryce. This one smells a lot in terms of, basically misleading and deceptive conduct.
Yeah. Well, there's a couple of things, right? I rang a couple of agents, contacts of mine yesterday, Ben. I said, here's a scenario. What would you do? And none of them said to me, oh, we would disclose that in writing. Both, there was a couple there that said, look, we would definitely disclose it. But it wasn't, the conversations didn't leave me full of, and these are good friends of mine, right? So, I'm not trying to kneecap them, but did leave me lots of confidence that the industry as a whole is just going, yep, this has got to be in writing. There's a standard that you've got. It's just we've got to let the person know. So it's a classic case of buyer beware. Now this is in Melbourne. Had a little look at the statutory requirements. Well, there is disclosure required here. It's illegal for a real estate agent to sell their own property without disclosing their interest in the property to potential buyers. So that has to be done. If they've got a financial interest, a beneficial interest, if there's a family relationship, they just got to disclose that, right? So it seems in this case, not only did that not happen, but there was a whole bunch of details that suggest that they were trying to actively not do that, right? But then you go, okay, well, there's and for absolute clarity, this wasn't one of our buyer's agents, but hopefully that's clear. The buyer's agent should be there to go, oh, right, well, that's okay. I'm here to save the day. But they weren't, right? And in this case, the buyer's agent said, well, that's just that. So the next part of my mind goes, okay. Does that mean that the buyer's agent, because you just assume that all buyer's agents are great, and like real estate agents, most of them are great and some of them aren't, right? And most buyer's agents are great and some of them aren't. So is there a case that there was a conflict of interest here with this buyer's agent? I wonder, because there seems like there's a few too many Dorothy Dicks that were avoided here. It's not like it's a house where it's unique. It's an apartment, so it's pretty easy to do some searches and to work out what others are paying. So if you're actually in the best interest of your client, that should have come up, and you pointed that out. But here's the worst of buyers agents behaving badly, Ben, if this happened, and I can't confirm or deny, right? But if the buyer's agent has a relationship with the selling agent, they've got a client, they've received a fee from the client to act in their interest, and then they've actually done a deal with someone who's got the maximum extorted out of the buyer, and that is ugly, because that's conflict of interest. Even if it's ugly to the point where the buyer's agent didn't get anything from the selling agent other than to just plant a seed in that relationship or whatever, that's wrong. It's even further wrong if they received a kickback from that as well. So these are the things, like, this is just some of the things that you need to be thinking about, folks. It's an insider's game. Property is an insider's game. It's not an outsider's game, and some of this stuff goes on.
So financial gain by deception. There's also, so when we talk about misleading and deceptive conduct, there's also a potential risk of a charge of financial gain by deception. So if they have colluded in this regard, because Jane is a novice and she saved 10 years for that house deposit, it's a shocking story. So Jane, what can you do? And again, this is in Victoria, but just remember in all states and territories, there are consumer government departments such as Consumer Affairs in Victoria, and they have usually divisions that specialise in property disputes. And so in Jane's case, she will be able to ring Consumer Affairs Victoria, and she should be able to have a conversation around the situation. That will then lead to the person from Consumer Affairs saying, I think you've got a complaint that could be lodged, and ultimately go through that process. So there is a complaint procedural process, and in the event that investigation then leads to the fact that this estate agent has willingly undisclosed interests in the property, they will face a reprimand in the form of potentially fined. There will be disciplinary action. Oh my goodness, I can't even get it out. They will face disciplinary. No good. Pass. You have a go, Bryce.
Disciplinary.
Yeah, no. Move on. Action by their governing body, and also they potentially lose their license in the industry. Well, I'm never going to. I can't understand why I can't say that word.
Just shows you human, Ben. Just shows you human. I can't even say due diligence without choking on my words.
There we go.
Disciplinary.
Thank you. Very good. You got it out for me.
Can I help you out here? Because it's you got PTSD, right? Because let's be honest, how many Collingwood supporters have been through disciplinary action? And so
I'll just wipe it out of my mind. So it's a horrible story. But I'd still be also asking around the buyer's agent. So why did we pay top dollar for this? Why didn't you show me comparable properties that would have disclosed that other properties in this apartment block were selling for considerably less? I think there's a complaint on both sides here that I'd be lodging if I was Jane, because it just doesn't stack up, and it just goes to show you, to your point, Bryce, is that we want to make sure that people understand that you want to be working with professionals. You want to be working with professionals, and if you've paid a professional fee to a buyer's agent, they're working for you. So if there's any collusion or any type of nefarious activity in terms of what's happening, then I reckon Jane needs to find out. And if you've got the government investigators in behind you doing that work, you may get your buyer's agency feedback, for one example. The selling agent, may have to have some type of financial settlement with you. There's plenty of potential opportunities here, but that's the starting point. Make a formal complaint through the real estate dispute resolution area of your consumer affairs body in your state or territory, and take it from there.
If I can add to that, Ben, there's a little side note that they say they can't take your complaint any further unless you've tried to address it with the agent first. So do that and bring it to their attention.
Yeah, I think it's a couple
of things. There's a book I've referenced a lot on this podcast. It's called Freakonomics. And there's a chapter within that book that talks about how real estate agents get paid and the incentive for that. But then there's a little subsection of that chapter that talks about when a agent sells their own home, they get more, right? So it kind of makes sense that the real estate agent is trying to get the most. So if we go back to the part in Jane's story, how she said, it's well within my budget. Okay, let's talk about how real estate agents work. Their goal is to get you inside the property. Once you are inside the property, then the game changes, right? The game changes to, how can I get the best for my client? Well, it just happened to be that this case, the client was actually themselves. So here's the learning point, because, to separate just quickly from Jane's issue, which is serious for her, but for the learning for the community, it totally makes sense that as soon as I went through the property, that it went straight to my maximum budget, because that is their job, folks. That is the job of the real estate agents. And again, I know lots and lots of wonderful real estate agents who are in the who do their job exceptionally well, right? We're talking about the 5-10% here. But in this case, every single real estate agent would do exactly the same. They would say, do whatever I can to get you in the property. That's what marketing has been. That's why the photos have always got a wide angle lens. They need you to walk inside the property, and then from there, the game changes. Okay? So there's nothing to be surprised about there. Another point here that's important for a learning exercise is Off markets aren't always the holy grail. Lots of buyers agents actually do their marketing pitch around off markets. They might quote 70% off markets, 60% off markets. In our business, Ben, we absolutely buy properties off markets. That is a fact. But it is not the anchoring point that we use to try and get someone to engage us, because I don't want our team to go, we guarantee that we're going to get you an off market, when that might not be the case. The best property might be on market, and quite often a lot of great properties are on market, and quite often a lot of rubbish properties are off market. So don't be seduced by the off market holy grail. Sometimes it's off market for a reason. Sometimes you don't actually want to go anywhere near it. And in this case, as Jane tells her story, she talks about how she got an off market property in Melbourne. Well, great if it worked, great. But in this case, it looks like it was off market for, we're speculating on a few reasons we've given, Ben, which could be dozens more reasons why, but they're starting to sound sinister as to reasons why this is off market. We are fully uninformed on what's going on here, but we're just drawing some conclusions based on the story that you told us. So off markets aren't always important. And the last one that I really want to, there's 2 points really. Second last one is, if I was going, I always liken a buyer's agent to an obstetrician, Ben, and just hear me out here. When you're putting a deal together is like when a baby wants to be delivered. They don't care what time the clock is, right? So, and secondly, when you're having a baby delivered, you want someone who's experienced, not someone who's inexperienced. And the same thing when you're putting a deal together for a property, you want someone who's experienced. So there are a lot of inexperienced buyer's agents in the marketplace. There is a group who is training them, and good luck to them. For people who want to be in our industry, it's fun, it's exciting. But here's the deal. If you were about to have, you're about to have a baby delivered, and you're interviewing obstetricians, would you want to get the person who's delivering the baby who's had 2 deliveries, or would you want the obstetrician who's had thousands delivered? Now, clearly you want the experience, and the same applies here. So if we don't go as sinister as we did before, Ben, and let's just say this buyer's agent had only been in the game for 5 minutes and hadn't had a lot of experience, they might not know what to do to resolve this. It's actually quite plausible that it's just above their pay grade. Like, they've taken the fee, they found you a property, but they don't actually know how to resolve it. Or they actually got out negotiated. Or they actually didn't realize when they signed the contract on behalf of their client, the buyer, they didn't actually realize that the real estate agent's name was exactly the same as the vendor on the contract. It's quite possible that they were incompetent, right? But that doesn't help poor Jane here because Jane's paid them a buyer's agency fee. Now, when they go back to the buyer's agent and say, hey, there's a problem, that person's gone, well, that's that. That's heartbreaking for someone who's saved for 10 years for this, Ben. And then the final thing for me is, I always say, outsource the execution, not the understanding. And that's an important point. People are time poor. There's a lot of reasons why a buyer's agent can actually get the job done for you better, but don't outsource the understanding of what they're doing. Don't be afraid to ask the buyer's agent, what do I need to expect? How does this work? How do you arrive at the price? Our team loves talking to our clients around that and around the process. So we actually want our clients to know what the process is. So outsource the execution. Do not outsource the understanding, because as soon as you do, you leave yourself in a position where you may be gained by someone whose agenda doesn't align with yours.
Jane, ring the agent. Ask them directly. Was the property that I bought your property? See what they say. Jane, ring your buyer's agent and say, how come you didn't supply me any comparable properties in the same apartment block? Like, there is mismanagement, unprofessional activity that's gone on everywhere in this particular case by the looks of things, given what we know so far. So I think you've got a case there, Jane, to scratch that itch and go and find out exactly what's happened and to see whether there has been deceptive and misleading conduct that's occurred in this particular case. Because that agent, if they can get away with this, and again, it's that bottom 5 or 10% that make it worse for all of the good operators. And I reckon those good operators would have no time at all for an agent like this, or potentially 2 agents like this, who have put self-interest above the interest of their client. So there you go.
Well said. Thank you, Jane, for being so transparent, and we feel your pain No one wants to pay too much for a property, particularly when they've got someone trying to represent them. Our second question today is from Marcus. Ben, this was a LinkedIn question that went directly to your account. And it's around real estate agents' taxation knowledge. Hi, Ben. Should real estate agents, in brackets, sales and property management, have proficient Australian taxation knowledge when managing real estate needs? Experience suggests that some agents don't have a good understanding of tax rules and can generate excessive expenses on the premise that it is tax deductible, when in some cases it isn't. This in turn can create unnecessarily high expenses that could take a while to recover from. Ben, do real estate agents need to have ample taxation knowledge?
Well, it's a classic story, Bryce, where, where do I get my advice from? I should get my advice from a specialist in a particular area. It's very clear from the way in which I look at this. And when I talk to Julia Hartman and when we share those insights with her about the technical knowledge that you need to have, the competencies, the understanding, tax law is complex. It is so complex. So you shouldn't be taking any advice from a real estate agent, mortgage broker, buyer's agent, anyone outside of that specialisation when it comes to tax advice. So I'm really clear on that. Yes, we do give some general knowledge around how functioning tax theory works, around, is this tax deductible, or if it's for investment purposes? Yes, but that doesn't necessarily mean that all the fees associated with that are instantly written off or available, or they form part of the capital cost. So it really is important to do that. So look, I'm going to be quick on this question. It's really, really clear for me, because I've also had experiences, Bryce, when I'm dealing with specialists where I've got a tax advisor and they both give me contradictory points. So from that point of view, I'm like, well, what do I do here? I'm like, okay, well, so if it's like that in the specialisation area, what's it going to be like in terms of dealing with a selling agent who's trying to flog a property to you, or a property spruiker who's trying to tell you this is a great tax story for you? So my ultimate rule of thumb is, golden rule is really simple in this space, is never buy property for a tax advantage. Always buy property for an investment return.
Ooh, nice one. Good summary there. Hey, back in 1999, Ben, I went and got my sales cert in Perth. It was actually 4 weeks. I did it for 4 weeks. So I went through all the modules. Not one single module talked about tax. It talked about advice. It didn't say anything about what can come out of my mouth to the buyer, right? So, and if you think about, to get your sales certificate, you don't have to do 4 weeks. It's usually a week now, in some cases a couple of weeks. So back in the good old days, Ben, it was 4 weeks, right? Then in 2012, I got my full license, right? So I go through and I do all the modules. Not a single module in there that was about what tax advice I can give. Not a single module that said, be careful, it's a big asset. You shouldn't be giving advice to people, all right? So if you think about why residential real estate is not considered a licensed financial product, it's because it is the only investment market in the world that's not dominated by investors. And so you've got someone who is doing an agency relationship for someone who might have a practical need, which is a house, selling it to another person that has a practical need for the house. And that is the large majority of the transactions that are going on. So therefore, it's very difficult to make that a licensed product when it's just a facilitating from two groups of people who want a roof over their head with this property, and they actually now want to move and live in that house and put that roof over their head, right? So the reason I tell that story is it's important to understand that real estate is much, 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 much bigger transacted as a non-financial instrument than it is as a financial instrument. Therefore, so the question is, should real estate agents have proficient Australian taxation knowledge when managing real estate agent needs? Let's be clear, that is not a requirement. It is not a requirement for them to facilitate a transaction between a willing buyer and a willing seller who may have zero use of it as a financial instrument. Now, again, full respect to all the professionals in the marketplace. So I've met a heap of real estate agents who make it their mission to understand taxation and investing, and they invest themselves and they read books and they learn seminars, and props to them. But But the baseline is they don't need to, because their fundamental role is to act as in an agency relationship to facilitate someone's name on this piece of land and taking their name off it and putting someone else's name on it. At its simplest form, that's what it is, and everything that comes on top of that land comes as part of the deal. So this question says, experience suggests that some agents don't have a good understanding of tax rules. Yep, 100%. It's going to stay that way.
Work on that premise.
Well, absolutely. And can generate excessive expenses on the premise that is tax deductible. My first mentor, who was a real estate agent, had two rules when it came to when he was teaching me about the world of real estate agents. These are pretty offensive to real estate agents, so I'm just going to say it. But the first one is, if an agent tells you it's their opinion, check. If an agent tells you it's a fact, check it. And if an agent tells you it's their opinion, it's a lie. Right? Now, I know that some people will hear that and their ears will bleed and they want to write me a letter. I get it, right? I'm just like, there's heaps of really good agents out there. But the point is, if they're telling you something about the tax deductibility of a property, A, they've got no good authority to give it to you. And B, their number one goal is to act in the best interest of their client, which is the person selling the property. And if they can use some words to help influence that discussion, they might do that. But therefore, if anyone thinks that they can rely on those words that are coming out of someone who has no authority and never will have the requirement to have the authority for the taxation knowledge, well, that's shame on us if we do that, because that's not their role, which is why you need to have an advisory team. If you've got a buyer's agent who's giving you advice on mortgages, chances are they're overstepping their authority. If you've got a mortgage broker who's trying to give you advice on your defense strategy, chances are they're overstepping their authority. Like if you've got a property manager who's trying to give you advice on what you should do for lodging your tax return, chances are they're overstepping their authority. So the point here is very clear that specific people do specific things within the orchestra that you're trying to conduct to get this transaction done. So should real estate agents have proficient Australian taxation knowledge? The answer is no. Would it be nice if they do? The answer is yes. But do they need to have that proficient taxation knowledge? The answer is no. So hopefully that's been clear for you, Marcus.
Well said, mate. Well said.
All right. The next one is from Michael, and this is about divorces, Ben, and it's speak pipe. So let's have a little listen to this question now.
Hi, Ben and Bryce. My name's Michael. I just want some advice. I'm currently going through a divorce. My ex and I had done pretty well. We had a house that we'd paid off in full, and we had 3 investment properties that we were paying down the loans on. My plan is that once we sell our family home and the 3 investment properties and pay all the taxes and costs, I should have enough money to move a bit further out and buy a house without any debt. I'm hoping to have $150,000 left over to buy an investment property with. My question is, should I perhaps borrow $150,000 to buy the house and have $300,000 left over to buy 2 investment properties? Thanks a lot, guys. Bye.
What do you reckon, Ben?
Yeah, I like this question, Bryce. It's obviously 1 in 3 relationships usually break down. So there's a couple of sort of angles we can chase after on this one. The first one for me is, all right, well, and this is all about the monetary outcome, remember? So I'm assuming, let's say hypothetically, it may be just drifted apart. So amicably sort of separating and we're drifting apart. The challenge you've got here is when you're selling your principal home, well, that's all right. There's no tax applicable to that. There's no income allocated because it's your principal place of residence, so it's capital gains tax free. However, the 3 investment properties, if you're like many people and you have a settlement and you're selling those properties all in the same year, you are going to have a significant amount of income that is declared in that tax year. Now, by doing that, you're going to pay a huge amount of tax. So my question is, given that Michael has aspirations to actually own some investment properties, if there's something amicable about that, could you stage the sale of, say, 1 or 2 properties over 2 independent income years, so 2 different financial tax years? So that could be true. Or could you keep one of the properties, the 3rd property, and manage that as a joint venture relationship? And let's say you plan to sell it in 3 years' time from now. That way, again, you'll potentially get the upside capital gain that still might be in the property, depending on the circumstances. So remember, we can't do Michael's specific circumstances, so we're talking general in nature here. So that would be something that you could consider if you're going through a relationship breakdown. Now, for those who, let's say it did end badly and we want a clear separation. That's it. We are done. Okay, I'm going to take my money. My partner's going to take their money, and off we go into the sunset. Well, the simple answer here for Michael is at $150,000 to hold back. No, if you've got an unencumbered principal place of residence and you want to potentially buy investments, including investment properties, the reality is you would pay down your owner-occupied debt, which is non-deductible debt, and you would potentially release that out as equity. So I'll let you talk more to that. What I wanted to talk about, Bryce, was more around the idea of how you approach this. So this is general information for all of our community. Always work back from the goal you're trying to achieve. So this is plan to become what you plan to become. So in Michael's case, as an example, Michael, do you have enough? Can you foresee, have you planned for, have you forecast, have you modeled that you will have enough income in retirement based on you owning your property outright and also any superannuation that you might have available to you? Now, as part of that consideration, you're also going to have to set yourself a retirement date time. You're going to have to work out in terms of what type of lifestyle you want to live in retirement. You're going to have to look at your commitments and the income that you're going to generate over that time. So if you know the answer to all of those questions, and anyone in our community works back from, the goal you're trying to achieve, work backwards from that, that will then inform you in terms of, do I have enough? Do I need to take on any risk to accelerate that, to accumulate more wealth? Because if I do, one property, is that enough? Is two properties enough? Because the simple answer here is, if you can control two properties, mathematically, if those are good properties, then you will create greater wealth over time. That's just the way it is, right? If all things are equal, that will be the mathematical model that will show you that you'll get a greater return. But the question is, do you need to do that? And that is ultimately about a decision of how comfortable you want your retirement to be, because by separating your assets, you are certainly taking one step backwards to obviously then move forward on your journey. So that's the way in which I would approach this, Bryce.
Yeah, I like it, Ben. So I really think there's 3 steps. One, first is to finalise the split. The second step is to reset, and then the third step is for retirement. And I reckon you've nailed it where you go, well, one's probably happening in the background as we speak. You said, is it amicable? Hopefully. Is it not amicable? Well, then there's a different path you go down. And then the third step of retire, what do you need? Work backwards. So that leaves us to the crux of the question for me, which is step 2 around the reset. So I don't think this question is around do I need the cash for 2? I think the question is, do I need 2 properties based on step 3 for the retirement outcome? And if the answer is yes, what is the best way to structure it? Because this is a structuring question. And so if the way you've said this, my question is, should I borrow $150,000 to buy the house and then have $300,000 left over to buy 2 investment properties? You can still buy 2 investment properties with alternative cash arrangements here. So if you go back to what Ben said, if you need to, and then you combine that with your super and you see that that's okay, because we've got no idea of your age from the question. You could be in your 40s, you could be in your 60s, we don't know. You could be in your 30s, right? So the idea is, go back to first principles. You pay down your most expensive debt as quickly as you can, which means that if you're going to buy your house a bit further out without any debt, but it meant that you would hang on to an extra $150,000 worth of debt on your principal place of residence and then using the cash to buy the investment property, you'd be violating some of the optimal tax deductibility options that are available, subject to you checking this with your accountant. But ultimately, if you use the cash to pay off the debt that you're responsible for, which is the home, then you go to an investment savvy mortgage broker and you say, here's my security. Can you use this security to help me get lending for 2 investment properties? Of great. Then you get the best of both. You've paid off the non-tax deductible debt with as much cash as you can, and then you've maximised your deductible debt where you can. Now, the spanner in the works could be that you might not have servicing, therefore that's why you need the cash. So that's why you'd need to do step 3 that Ben talked about before, which is actually, what is the North Star? What are we trying to do? You've split now. You're now resetting. What does retirement look like? What does retirement look like is super important to answer this question. Because if you've got borrowing capacity and you need a couple, then at face value, you probably wouldn't want to use the cash. But if you don't have borrowing capacity and you still want to achieve that, that might be something that you need to pivot. So it kind of talks to the point, Ben, that we need a bit more detail. But in optimizing 101, we want to minimize non-tax. Geez, you and I are having trouble speaking today. You want to minimize non-tax deductible debt. Oh, you got it. You got it. The non-tax deductible debt and maximize your tax deductible debt.
Now, this is where people can sometimes get a little bit confused, Bryce, because this is a case-by-case situation. So you would have heard us on this podcast say you have a choice with surplus cash flow, so that you are generating on a month-to-month basis. So in other words, is it better to pay off your home first before you start investing? Mathematically, no. But in this particular case, what Michael's getting is a lump sum of money, which means that he has the ability to actually clear all of that the non-deductible debt and have his principal home debt-free, of which he can access equity. So that's what you're talking about structurally. So, because if people had been listening to this and thought, well, wait a minute, I'm sure it was, it's going to take us 20 years to pay off our home loan, then we're going to start investing. No, the models will show you that you are better off, working towards paying that down slowly. And in some cases, the more aggressive models of the higher risk says you have that interest only and you put that money to work. So I think this particular case is because we're getting a lump sum. So this could also work for an inheritance in terms of basically paying down, to your point, Bryce, your highest cost debt, which is in this case non-deductible debt, which is your principal place of residence home, makes perfect sense.
Beautiful. There we go. So great question. Hopefully that's been helpful. But that's a structuring question, Michael. It's a structuring question, not a cash question. So hopefully that's helped. Let us know if you need some help talking to someone who can help you with optimizing your finance structure. The last question here, Ben, is from Alex. It's a very timely question to the times we're in now, Ben. It's titled Unplanned Hits on Your Buffer. Let's have a little listen to Alex's question now.
Hey guys, I've been a property investor for almost 25 years and during that time I've accumulated a handful of properties. I've been relatively conservative. Currently my net equity is more than 50%, and I've always run buffers. In fact, before the first rate increase, I had about $100,000 in my offset account. And since then, the interest expense has gone up almost 3.5 times. So when I've run my projections, the numbers indicate that I will be out of buffer by about this time next year. So my question is, after you have allowed for all of the known financial adjustments in your buffer, so all of the things that you're planning for, how do you account for the unknown components to your buffer? Is there a ratio or ratios and various calculations that you run and assumptions that you run as part of that? I'm hoping I'm not the only person in this situation, so it leads to a good conversation and some good learnings for the rest of your listeners. Appreciate everything you do, and back to you, gentlemen.
What do you reckon, Ben?
I love this question, Alex. Thank you for sharing it, because I suspect there will be a lot of people around the country looking at their cash buffers, looking at their debt levels, and I'm raising my hand here as well.
Yeah,
we've had significant increases in the interest costs to control the properties that we currently control. So I'm going to answer the first part of this question, which was a clue around exhausting all of your other alternatives. Now, from my experience, Alex, and in obviously dealing with thousands of client scenarios, I'm going to share a little insight. The first one here is observationally that there is often more ways in which you can extend your buffer position. And I'm going to give you a couple of examples. So if your buffer is planned to run out in basically another year from now's time, then ultimately our job, our main focus is how can we stretch that out further? And there's a couple of ways in which we can do it. One is around the decisions we make around essential and discretionary spending. And the other one is, how can we increase income during that time? So a couple of good examples. These are trade-offs. And, when push comes to shove and when it absolutely you get pushed to the wall, are there any other options? Well, here's some examples. You may have decided that football is a passion of yours. You love going to the footy. And so for you, that's a non-negotiable. But I'd be saying, well, that time is valuable to actually earn other money. So if I said to you, if push comes to shove, could you take that football experience away for 12 months and drive an Uber at the same time you might have been going to the football? So there's new income coming into the household, which is stretching that story. The other one is obviously the classic one around selling assets that you're simply not using. So get on to Gumtree and eBay and so forth, and off you go. So there are always further ways in which you can do that. And obviously the classic one, but I'm assuming you've already done this, is essential and discretionary spending. It is a no-brainer to be ruthless on the discretionary component, the lifestyle component, for a period of time, because this links into the next part of the question. Alex, as you mentioned, if I'm experiencing this, many other people would be experiencing this too, 100%. And if the vast majority of us are experiencing this, which in our case for across Australia, around 30% of people who have mortgages and outstanding debts across their property, maybe it's 30 to 40, 50% of people who are getting impacted by higher interest rates, it is going to make a material difference over the remainder of this year. And so the moment that stops spending, consumer spending, that means businesses are forced to discount. It means inflation pulls back into check, and it ultimately means interest rates are coming down. So you want to be working currently, as we go to air and record that this week in April of 2023, you want to be working that interest rates will remain high at this sort of level. There may be one more in there, but it's more unlikely than likely. But that's pretty much it. Then we're tapped out on interest rates. So you want to be working on the fact that interest rates will stay here for around 12 months, maybe 18 months. But at some point in that conversation, rates are going to come down. And that's going to take a bit of that fixed cost pressure off you. So that's what you're trying to do. You're trying to say to yourself mentally, and this is for our entire community who are feeling these challenges, is what can we cut for the next 12 months that will allow us to hold that asset, which comes back to your initial introduction, Bryce, around, people tapping out, when the headwinds are coming, that the easiest way to get out is to just cash out and then think that they're going to reset. No, the courageous way is forward. Always keep going forward. Try and hold on to the assets as much as possible. Do everything you can to try and keep the assets, because the recycle costs of getting in and getting out and starting again are material. And they're probably far more material than you think they are in terms of the opportunity cost and the capital gain, and again, also stamp duty and selling costs and the like. So they are the really critical things that you want to be thinking about when it comes to that. So my takeaways: manage through the tight period, and remember that this will pass. So interest rates will come back down to a more normalized level. With inside my current estimates are around 12 to 18 months, we will start to see interest rates moving back down. Where does that live? Well, it depends on how stubborn inflation is, but let's call it between, say, 2.5 and 3% is where they'll probably start to equalize. So if you then start to think about normalising those interest rates during that time. And if the economy goes pear-shaped even further, they're probably going to go down towards closer to 2%. So that's going to give you some idea. And we were talking off air. I mean, a quick rule of thumb here, 350 basis points of increases on $1 million, that's $35,000 in additional interest repayments, not the principal, just the interest repayments for every $1 million that you hold. So that just gives you some idea in terms of why, in Michael's case, 100 grand can be sucked up really quickly in terms of the buffers that he's currently got.
Well said, mate. So a couple just extra footnotes, right? So you said the equity is more than 50%. So we're going to run the assumption that you are tapped out on borrowings. But if you're not tapped out on borrowings, you may be able to go and borrow an extra 25,000, an extra 50,000, which will give you another year, right? Because if interest rates are at what we perceive as the top now, generally the direction is probably down at some point in 12 months, in early next year and early to mid next year, right? So if you can actually borrow a bit more buffer, because the thing is that you don't want to throw the baby out with the bathwater. Ben said it in a different way just a second ago, but the ultimate game here is action. Remember at the beginning of the Mindset Minute, action, be prepared to face some headwinds and then actually be able to hold it for a long time. So this is where we need to be able to do that, right? So a couple of things. If you could borrow for your buffer, are the rents on, you said you've got a handful of properties. Ben and I had a debate. What does a handful mean? I said, we got 5 fingers. It has to be 5 or less. He goes, well, maybe it's 6. So, okay, let's say it's 4 to 6 properties that you've got. So that means, are all the rents on the properties optimal? And I am aware that we've got listeners to the Property Couch, Ben, who are tenants, right? And they're going, whoa, back off there, buddy. Like, rents are already tough enough. We've just found a property. Now you want to put them up? No, I'm just saying, are they optimal, all things considered, right? So have you had, rents at a level that aren't at market for some time? That will also help you there. And finally, getting full line of sight on your numbers, right? Which is a different way of me saying, the amount of people that have rang me and said, I've accumulated this over the last little journey, Ben, I haven't really experienced interest rates rising before, so I'm not sure how to navigate this section. I say, well, just get a line of sight. Our planning team has got a lot of people just coming in where they just go, all right, put it all into the system and let's just run a couple of what-if scenarios here. So I would say to you, if the goal here is to be Warren Buffett and the goal is to actually, and we're assuming you've got great properties here, right? And you want to hold these for the journey, well, this is the messy middle where you need to explore all the opportunities that you have, to the points that Ben said, but all the opportunities that you have to actually just get a bit of line of sight on, am I boxing at shadows? Is there something real that I need to be considering here? So if you're going to make any decisions, you're making it based on facts, not fiction. So Ben, there are some ratios in the team that you want to chat to that can be some takeaways for the community here.
Well, that's the final part of the question. Is there any ratios or things or various calculations that you may run? So let's teach you in terms of how we approach this. So we, in terms of the modelling and making the invisible visible that Bryce was just talking about there, is that if we run a model in the accumulation phase as you're building out your plan, where there must be a minimum 6 months. So a minimum 6 months of buffer. Now that's the minimum. So in other words, that's the higher risk zone. But ideally, we would want that to be a minimum of 12 months of that buffer. Now, here's where it changes subtly. That's assuming current spending habits. So if you were to then separate out your essential and discretionary, the reality is that if you went just to essential, 6 months should at least push you to 9 months, but more likely 12 months. So that sort of gives you some idea of just how much lifestyle spending we actually do in households. And so that's about really tightening the belt and just being really careful about your spending habits. So as a minimum, you sort of think about that. If something was to change, that gives me that 12-month period. Now, of course, any time that a job is lost and those type of things, we are obviously thinking about those as major events, and that will obviously also mean that there might be significant impact on that. So we're always thinking about 6 months with current spending and current job. Now, in terms of when we get into retirement, when we do our planning, we are even more conservative around how we access income. So if we use the example of the $2,000 a week models that you might run and we build, the reality might be, okay, you've got 4 properties, but because you started later in life, there's a little bit of residual debt that's left over. So we work on a model that you keep the properties even though you're retired. And then when your cash balance, when your cash buffer gets to $100,000, we would model in the sale of one of those properties. Now, we obviously have to pick one for the model, but we would make the consideration closer to that date, because these models are 10, 15, 20, 30 years in advance. So the reality is we've picked X property in 22 years from now, and that's the one we're going to sell down. And it's usually the property that's performing the least amount of capital growth is the one that would be first off the ranks. But in some cases, we'd also consider, when we're talking to the financial planning arm, whether we would use super to also continue on that story. So you're going to have lots of choices when you get to retirement about the levers that you pull and how you continue to stretch that time out. But a good rule of thumb is $100,000 in cash position before we trigger a sale. But when we're in accumulation phase, a minimum of 6 months is tight. We'd prefer you sort of landing in that sort of 12-month zone in terms of having those buffers before you pull any trigger on any sale. Because usually what Alex is also referring to there is you don't want to be a forced seller in a marketplace that's got pressure on it because everyone else is also tapping out. So that's why you want to be in control of that conversation. And that's why you also want to make sure that if you can trade through those heavier periods, you're going to be in far better shape, and you're not going to have to sell in a distressed time. So, and hopefully not sell at all is the ultimate outcome there.
Yeah, that's a good point to underline. The idea is that you get to retirement and you've got them fully paid off, and then you're holding these. But that's not always the case for everyone. Some people can't do that. But the whole point is to get the $2,000 per week. Some people get their $2,000 a week with no debt. Some people get their $2,000 a week with some debt that they're still servicing. Some people have to get the $2,000 a week by selling some properties. But the idea is to try and keep them as we can. And Ben, I guess the whole reason for us saying buckle down, try and get this done, is because there is already evidence to suggest that we've bottomed out. There's plenty of stories now being printed, and it just shows how quick it turns, Ben. That some of the journalists are writing, well, now's the time. The conditions look pretty good. We've maxed out on inflation. We've maxed out on interest. So the stuff that you and I were saying back in February, trying to give people a head start, that's all starting to make mainstream media now. So the idea is if Alex has great properties, now is not the time that you want to be offloading them anyway, because I think we're about to enter a period where due to chronic shortage in rentals, in stock, and all the people that are lining up to come to this country and live here, I don't see us having this big runaway boom, but I certainly feel like the trend is going to swing back towards the north rather than the south. So it's something for people to digest as well.
Yeah, we're seeing, as predicted, we're seeing a lot of email spruiking going out there. The next boom is here. You've got to move quickly. You've got to act. You've got to remember that's a self-serving agenda from those property advisory businesses or whatever they're doing, property spruiking businesses. So just be careful there. To Bryce's point, it definitely feels like the bottom is here. If inflation remains stubbornly higher, we might bounce along the bottom, but there's certainly going to be good buying opportunities for those who haven't got in. You've got sort of more upside benefit than downside risk is our view. But to Bryce's point, you're not going to hear us talk about boom conditions. We're going to potentially see even improved conditions when interest rates do eventually come down. But it's a nice time to be adding to the portfolio if your current circumstances provide that opportunity to do it. Come back to our fundamentals. The cash flow allows for it. Your job security is there. All those things. Because remember, we want you to buy 2 or 3 really good ones. And then that's going to supplement your super, and you're going to have a really comfortable retirement. We're not a get-rich-quick advocator in terms of what we do here.
We're the Get Rich Slow
We
podcast.
are.
So we should
We
have
are.
it in the subtitle. Special thanks to Jane. Another thanks to Marcus, to Michael, and also to Alex for their wonderful questions, Ben. Normally, if you do the speak pipe, you get a start and build. So if they want to reach out to us, we can give a start and build, Ben. And I think by association, I think Marcus and also Jane got sucked up in the slipstream of that as well. So if they want to reach out to us, we will give them a copy of Start and Build. And I want to use this opportunity to let people know that if they go to thepropertycouch.com.au, there is a little button. It's called Speak Pipe. Leave your question. You can see from that last question, that was incredibly relevant from Alex as to what people are experiencing right now. So if you ask those questions and we read it out, we will also give you a copy of our Start and Build, which is normally just under $500. So that's all for you. Hey, my life hack today, Ben, is all about reading books with better comprehension. So I've noticed a trend recently that I've been avoiding physical books for a bit, and I think it's because I want to consume books in those cursory moments when I'm pushing the lawnmower, I'm riding a bike, I'm out for a walk, I'm driving the car, right? But then I get a bit frustrated as well because there's no chapter titles. It's harder to preview the previous chapter takeaways. Multitasking is a negative when you're driving because you want to emphasize that point, you want to rewind, you want to actually go through it, and when you've actually got the book, you can reread those lines, or when you're listening to audiobooks. So I've on the thesis that learning requires application, not just consumption. If I want to apply these books, I've started reading a few more physical books, but I won't lie, Ben, I feel like, every time I pick one up, I think, oh, it's going to take me ages and all that sort of stuff. But so what I've been doing now is a little hack to help me preview the material, right? So before reading, I'll dive into it and I'll take a moment to preview the material. So what I'll do is I'll look at the headings and the subheadings to give me an idea of the main topics. Then I'll skim through any summaries or introductory paragraphs so I get a bit of an overview on what the topic is and sort of try and bank that. I definitely look at any of the visual aids or the graphics to give me a sense of the main concepts and the relationships. And then here's a big one for me. I check the length and the format to give me a sense of how much time I'll need to allocate for the reading, whether I'll actually enjoy the diving in or the skimming generally. I might just, because I've got heaps of books like you. I know we're students of life. I can't get through them all, right? So I've got to work out which ones I'm going to actually invest in or which ones I'm happy just to take the skimmed takeaways from. And then I'll be able to make an adjustment on, the reading strategy. But as I say, there's a couple that I'm reading at the moment. Hopefully they're guests that we're going to, I know there's two that we're going to get guests on to share. So I'm doing my pre-reading in advance, but that's just a little hack that I've got so I can get back into the physical books, Ben. I've tried the Kindle with the Audible on, so I'm actually having the author talk to me whilst I'm skimming to keep my eyes focused. I've tried a whole range of things, but it's just I think it's like the movies, Ben. The movies are never going to go out in fashion because you're always happy to have the event of going to a movie, even though you can download it on Netflix or whatever. I think the old-fashioned book is never going to go out of fashion. So my life hack today is some tips on previewing the material before you launch into a book. So for people who struggle like me, I'm picking up the physical books. What's making property news, mate?
Yeah, a couple of stories caught my eye this week, Bryce. There's a developing negative story further out of the UK. Poor old UK is a bit of a basket case, right? They haven't really been able to do anything well after their Brexit failure in terms of what that looks like. But this is where it's now getting to. What the story that caught my eye was out of news.com.au, and we'll put that in the show description. But it's talking about dobbing in your neighbour scheme in cracking down on vacant properties. So forget the fact who owns the property, Bryce. Forget the fact that it's, ownership gives them some level of control about whether they want to rent it out. But no. What they're trying to do in parts of London, because there's such a chronic shortage of rental accommodation, is they want you to dob in. They want you to dob in properties that you think are vacant that could be used for rental accommodation. Wow. I mean, what does this tell you about the absolute complete failure of the governments and the people who are in control of the regulatory environment over there? Okay, so you got a problem? There's no rentals. All right, well, How do we fix this? Well, obviously you could do a lot. You could actually help with reform. You could look at the supply constraints. You could look at the regulatory and planning red tape that you put in front of it. You could take some of the taxes away. No. Those people who own property. Those people who own property, it's their fault. It's their fault that they own it. And they shouldn't be so greedy, and they should let random people into their property for a bed, for a room. You can see where I'm going with this.
I can't help but get the image of Uncle Arthur. Ben, you remember Uncle Arthur on the comedy? I can't help but get that image. Like, most people are listening to this, but I could see you, and you almost go into that Uncle Arthur character when you.
Oh. Anyway, so that's the consequences of failed management of the market. Because you've manipulated the market. You've made it near impossible for investors to go and buy properties in the UK anymore. You've suffocated supply. This is the consequence. And now you still want to dob them in. I mean, it's just absolutely absurd. It just goes to show you that a free market is often very efficient. It still needs some regulation in there, but the more you interfere, the unintended consequences are real. And speaking of which, Bryce, the second market that we wanted to talk about was the real sad story that we've been mentioning. I talked about it a lot in the economic and RBA updates at the end of last year about the tsunami of risk that was going to occur in the construction area of residential property on the back of, obviously, the home builder, which put a massive spike of new property construction. Now, in a lot of cases, builders such as Porter Davis and all of these failed builders that are emerging across the country, some of it was out of their control. Normally a two-story home would take 26 to 28 weeks to have a build program, and that's how they factored in their costs. But when supply constraints and materials are in delay, those build program times blew out, which obviously meant that ultimately those properties were not being completed, which meant that there was a liquidity crisis inside those particular residential building businesses, and we're seeing collapse of some of the most significant building, providers and developers in this country. So it's a really sad story. Obviously, wage costs have bloomed through shortages of skilled labour. So it's a massive problem. And unfortunately, Porter Davis, 1,700 homes in Victoria. They won't be the last. There will be more that will come in this particular space. And we're definitely seeing some stories around, the support that are coming from different areas. We do have some insurance authority funds that are kicking in there, but I just wanted to shout out to those people who have got half-built homes, who are unsure in terms of what's going to happen around their construction. They're going to have to pay more for that. The flow-on effects is the building industry are trying to get lenders to not have fixed price contracts. That makes it near impossible for a lender to have confidence around bad debts in terms of cost blowouts. So unfortunately, there is going to be a big reset when it comes to house and land packages and off-the-plan properties across the country. And so that's going to take years to fix. So it really is a pretty ordinary story. We forecast from the middle of last year that this was going to be a risk. It is starting to be realised, and so our thoughts and prayers are out for those people who are struggling in that particular case and who now have to go and renegotiate new contracts with new builders to try and get their homes built, or in some cases, some investors are also potentially at risk as well. So it's just not a good story.
No, it's not. So I know some people around the corner who are affected by that. So very good, mate. Thank you for sharing what's making property. It's been a big show, Ben. We love Q&A day. It's always been our sentimental favourite, where we get to talk about the questions that matter the most to the people who are listening to our podcast. So thanks again to those people that have contributed. Thanks to you, mate, for bringing your A game as you always do, mate. Until next week.
Knowledge is empowering, Bryce, but only if you act on it. That's superpower. Act.
Exactly. See you next week, folks.